Hello, this is Eric Carbonell from Skeptics.com, and I'm going to talk a little bit more about the US money supply. This right here is the US money supply, and this white area is M1 plus this green area, which is currency. If you look, the ratio of M1 to currency is about 2 to 1. M1 is twice the size of the currency. Now let's compare that to a few other currencies. Okay, here we have the euro. And right here's the currency in circulation. And here we have M1. It's about 6 times more M1 than there is currency in circulation for the EU area. Here's another example, Australia. Currency, M1. Again, about 6 times the size. For the last example, here we have Japan. M1, currency, and then M1. About 5 times, about. Now, looking at the US again, you'll notice that compared to other major currencies, the US has a lot of currency in circulation. And the reason behind that is because the dollar is the world's reserve currency. And most of currency in circulation is actually held abroad. Here's an estimate for how much US currency is held abroad. As you can see, between 65 and 70% of printed dollar bills are circulating in foreign countries. Now, why do foreigners hold US currency? Well, they do it because foreigners think of the dollar as a reliable source of purchasing power. And because of the US's political and economic stability. Finally, there's the fact that the US has never yet it's poor yet, but terrible yet, but anyway, experienced hyperinflation. So what does all this mean? It means that in the Federal Reserve's balance sheet, here you would have the currency in circulation. Well, about 500 billion of that is held abroad, in dollar bills abroad. And the only US part of the Federal Reserve's liability is much smaller, around 300 billion. Looking at the numbers on the Fed's liability side of its balance sheet, we can see that currency circulating in the United States versus abroad is about 240 billion. And using that number, the real U.S. monetary base on which all the other U.S. money supply measures, checking accounts, everything is based, is around $280 billion. Looking at the money supply chart that we started at, we can now realize that most of this currency here doesn't exist in the U.S. money supply. It's foreigners held abroad, and it's not helping multiply the money supply at all. And so here is the same chart with a slight adjustment, taking out that excess money supply. I'll switch between the two charts so you can see. That is the normal one, and this is making the adjustment for taking that extra currency out. And now you'll notice it's starting to look a lot like the EU area and other major currencies. The M1 is probably about 4 or 5 times the currency in circulation, which is about right. Taking a close-up look at the US monetary base, we can do the same thing again, which is we cut out the amount of currency held abroad, and that right there is the real US currency. And this right here is the Fed's quantitative easing. And what is this quantitative easing? Well, if you look at components of the monetary base, here we have, again, remember this currency down here, that's abroad. So you have the money supply, you have the reserves that banks have to keep at the Federal Reserve. Then you have excess reserves. That's quantitative easing. Basically, think of the Fed is giving cash to banks for their worst assets, which is basically giving them cash for free. And as a result of that, they're storing excess reserves at the Federal Reserve. But wait, it gets worse. Remember how this is held abroad? Well, foreigners, as the dollar loses its reserve status and people begin to doubt that the U.S. will ever repay its debt, foreigners will begin sending this money back. And that's going to increase the U.S. money supply. But wait, it gets worse. If you look at the U.S. money supply, all of this is insured by the FDIC. And some of this up here is insured too, like the senior debt of banks, but I won't get into that. So if you have what happened during the Great Depression, which is widespread bank failures, the Fed is going to be monetizing a lot of insured checking and saving accounts. This is actually the reason why deflation isn't possible in the United States as long as the FDIC is insuring checking accounts. During the Great Depression, when 2 out of 5 banks went under, depositors were wiped out. And all this up here was gone. And you had actual deflation. The money supply shrunk as a result. The only way for that to happen again is for FDIC insurance to be removed. And I just don't see that happening. Alright, to summarize, this is a result of the Fed's quantitative easing so far. This is about the amount of dollars held overseas that's going to be coming home as the dollar loses its reserve status. This is about equal to 2 out of every 5 banks, which is a number that failed during the Great Depression, and that's about how many deposits are going to be monetized. This is the between $3 and $4 trillion federal deficit, and foreign nations, all the treasuries that are going to be sold that the Fed is going to need to monetize. Now, if you're keeping track from up here to down here is about 40 times. There is no way the US is getting out of this without a complete currency collapse.